Okay, next up we've got build versus buy or private versus public, all in the context of tokenization of real world assets. So please welcome the panel.
Great, thank you very much for everyone, for everyone attending today for the build versus buy or public versus private for the tokenization of real world assets. We have some fantastic speakers here, and we're going to just kind of run through the background, some of the use cases and necessity for the tokenization of digital for assets, as well as some of the challenges and headwinds that we think we will be facing. So why don't we start off, and let me allow the panel to introduce themselves. So why don't we start with you, Morgan? Give a little bit about yourself and what you're up to and where you're from.
Thanks, Elliot, and good afternoon, everyone. Morgan McKenney, CEO of Provenance Blockchain Foundation. Provenance Blockchain is a layer 1 blockchain in the Cosmos ecosystem focused on supporting regulated and institutional finance. We have $7.6 billion of real-world financial assets natively issued on Provenance, and we can get into the use cases that we're supporting. Previously, I was at Citi, so recovering banker around the world.
Hi, great to be here. Ollie Harris, Managing Director at Goldman Sachs, help look after their digital assets team. Think of us as the one-stop shop to all things digital assets that spans the continuum from cryptocurrencies through to enterprise blockchain. And yeah, excited to be here today.
Hi everyone, I'm Yuval. I'm the co-founder and CEO of Digital Asset. We are a technology company that developed a smart contract language, and next week we'll announce a new development in the space.
Hi, good afternoon, everyone. That'll do. Good afternoon, everyone. Anthony Woolley from Onera, Head of Business Development at Onera. At Onera, we're focused on just one problem that you'll hear a lot about today and tomorrow. We're focused on opening up distribution for tokenized real-world assets because we're dealing with the tokenization of the largest market on the planet. And as successful as any particular venue or institution is in distributing tokenized assets, the size of this market, we're focused on connecting all of those venues, institutions, wealth managers, private banks, to open up distribution at a global level.
Great, thank you very much, everyone. So why don't we set the stage and the background for everyone here? I mean, we're talking about the tokenization of digital assets, but ultimately, really, is TradFi ready for that? Is TradFi ready to adopt a public decentralized blockchain system? And Morgan, why don't we start off with you? And if anyone else has any other thoughts, please chime in.
Great. Well, one of the early OG implementers of blockchain at Citi, twice, once in 15, 16 with NASDAQ, and once with 19 and 20 with Alibaba and Ant, successfully in production at Citi. And that each took 1.5 years of my life. It was hard work in addition to the day job. Fast forward to 2022, and I would call 2022 the first year where traditional financial institutions adopted blockchain successfully, in public, by the way, as well, in their core business, right? If you think about a Bank of New York Mellon launching digital asset custody, obviously what Goldman has done, Apollo has issued natively LP interest in their Origins funds on Provenance, as an example, and Figure has white labeled their digital HELOC product to a whole bunch of mortgage originators that allow somebody online, a US customer, 70,000 households, to get a HELOC in a 5-minute application process and money in their bank account in a few days. So I think we've seen some great adoption. And one other key data point is Figure, who is a pioneer. It's a fintech, right? So built to apply their business on blockchain and derive value from it. Recently, with Goldman as one of the lead underwriters, basically issued a securitization, an asset-backed securitization, first of its kind on digital HELOCs. So the securitization wasn't done on blockchain yet, but that will be a step into ultimately putting that securitization on chain, as well as the underlying assets which are already on chain. So more to come, but the answer is yes, and each of the banks have large digital asset teams. They have strategy supported at a board level and are working on the use cases that are most impactful to their business and their clients.
And that's interesting you raised that example because we see it in other areas as well. We've seen digital bond issuance that's come out recently using blockchain and smart contracts, and some would say maybe that's just a little drop, a small drop in the ocean. But Yuval, I think this is something that's very interesting for you. But I mean, what gives you the confidence, or do you have any confidence that this is technology that has a place in the TradFi mainstream?
So I think that if you add to what Morgan mentioned, I can tell you, at least from our perspective, we're seeing bond with Goldman, Deutsche Börse is issuing daily structured products. Broadridge is processing, I think, over $100 billion of repo transactions daily. And again, I actually think that even though these numbers may seem impressive, they're actually still a drop in the bucket, right? They're still tiny numbers. The reality is that when you start touching money and assets, things move slow. And especially if you start thinking about the regulatory scrutiny, not specifically about crypto and digital assets, generally speaking, in financial services, people are risk averse. And the reality is that as long as you can show real business value, and I can talk about Goldman showed that bond issuance process went down from having 100 people involved in the issuance process to effectively 0. Deutsche Börse took down, I think, the issuance of structured products from 3 to 6 days to real time. Broadridge is showing real P&L impact from tokenizing collateral and moving collateral more efficiently. And I can talk to you life insurance, horse racing, and we can keep on talking about other use cases. I think that no different than any other technology, if you could show real business benefits, you're going to have success long term. And you know, that's what we've been trying to focus at Digital Asset, is make sure that technology has to be only second, right? At the end of the day, everybody can say, look, my technology is shinier or better, and there's going to be good reasons in every other direction, but if you cannot nail really the business outcome that you're trying to solve, you're really going to have nothing. So for me, what gives me the confidence is actually seeing the real results from some of these early implementations, and that's just going to increase the momentum over time.
Right. And actually, when we do talk about this private versus public, excuse me, for tokenized assets, going to your point about finding a business use case, right? I mean, Anthony, I think this is a question for you. I mean, what is the business use case? I mean, it sounds like there's several here, but just broadly, and maybe there's specific examples you can give as well. Is there anything that that you have any thoughts on?
Yeah, I mean, we're working on multiple projects at the moment with some of the largest financial institutions in the world, and every one of those institutions understands the scale and potential of this space. First and foremost, many of them are focusing on tokenizing real-world assets in the world of private markets. It's a world that's currently completely offline, runs on PDF and Excel and such like. And the business case there is massive, right? The private markets are many times bigger than the public markets, but that's the silent markets because there's no distribution and there's no liquidity. In the world at the moment, there is supply. There are many real-world assets out there, talking about the largest market on the planet, and there is demand, right? You have a situation at the moment where over the last year we've seen that equities and bonds are actually quite correlated. Financial advisors who used to push the 60-40 ratio for investing, maybe that's not the best advice nowadays. You know, investors want to diversify their portfolio into alternatives, private markets, etc. What this technology can unlock is the potential to take those private market assets, high quality private market assets, start to digitally distribute them, create a digital chain between the asset and the ultimate beneficial owner. If you can create that digital chain, you can start to unlock digital distribution, bring down ticket sizes, and ultimately unlock a secondary market. And that's amazingly powerful, and ultimately when you've done that, you can start to provide the investors the ability to borrow against those assets, and you can start to collateralize the world. So there's absolutely enormous, massive potential there. I think all the large institutions can see it, they understand it, and what they're focused on is how do we implement this as an industry? How do we come together? But how do we do it in a unified way so that investors can access those assets wherever they are without having to worry about onboarding onto multiple environments in different parts of the world, etc.
Right. That's sorry. Go ahead.
I was just going to build on a few of those points, which is, yeah, I think Yuval's entirely right. We have to focus on business outcomes, and we obviously all live in like a resource-constrained world. So I think within teams like mine and across many companies, we're obviously focused on like ranking and prioritizing, like, what are the right products and use cases to look at with this technology. And that's like top of mind to generate commercial outcomes for our clients and our firm. And yeah, we can talk, ad nauseum for days on like all the different use cases, because I think that's clear, and that's why we're all in this room. I think on the public versus private piece, at least my 2 cents is, we're very much business focused, looking at commercial outcomes. The technology is second. And I do think there's this like misnomer or false dichotomy around like public blockchains versus permission blockchains. Obviously, from a public perspective, again, there's a lot of like emotion in that word. Generally speaking, from a regulated institution like us, there are safety and soundness issues like KYC, identity, validation, smart contract risk. Like, there are a lot of risks and issues that need to be addressed before it'd be permissible for institutions like us to act on, public blockchains. However, there's a ton of value we can do in the permission space, and over time, actually, these worlds will converge, and you'll see, this sort of dichotomy now actually become a continuum.
Can I just jump in there?
Yeah,
because I've implemented 2 private blockchains, and we're proudly public. However, we have permissioning, and we have the ability to spin up private and permission zones, which we've done. So I think I totally agree with Ollie. The regulatory context is so challenging, and the technology, the public chain technology, that has risks, right, that need to be understood and bedded down. But I think we're seeing an emergence of solutions where we have this, $8 billion of financial assets by non-bank financial institutions on the public net, but we've already spun up for USDF, our bank minted tokenized deposit. That has a private permission zone where you can control who the validators are. And Figure Equity Solutions, which is young companies' cap tables issuing equity. That's also in private permission zone. So I do think we need hybrids as the technology matures, but overall, public blockchains ultimately down the road offer true open innovation. It's crowdsourcing the future finance. It really does help, I think, deliver the promise of blockchain, which is bilateral transactions amongst 2 counterparties.
So, Yuval, why don't you? It sounds like you had some comments.
Yeah, I think it. Again, I think that there's no disagreement that the user experience from a public chain is something that you can't compete with. It's like, imagine if you needed a different web browser for every website you wanted to go to. That clearly wouldn't be a user experience that anyone would accept. But again, you have to put that against the things that Ollie talked about, which are business outcomes. So regulator needs to show, you need to show that as an issuer you can perfect title, and that if things go bad, there's resiliency and soundness of the system. So at the end of the day, I think, like Ollie said, those lines will get blurred, and there will be that public chain or internet type of user experience. And I know that that's, for example, what Onera is trying to do, that you don't really care what is happening behind the scenes. That being said, the issuers and the financial players that will facilitate these transactions will really care. Can the underlying technology provide all the safety mechanisms that I need to provide for my investors and my regulators?
So, yeah, I was going to add, I mean, when people talk about public and private blockchains, all this tech stuff, in a way it's a proxy for a deeper conversation, because what people are really trying to say is you've got traditional finance where things seem quite centralized, and then you've got what we're inspired from the world of crypto, this mass decentralization. But Morgan finished a minute ago by saying really what you're trying to do, the business problem, is you're trying to bring closer connecting assets with investors, right? And the distribution technology we have, we don't tokenize these assets ourselves, but we don't mind whether the assets are tokenized public-private blockchains. We're agnostic to all of that. But what's important is the ability to connect on a peer-to-peer basis institutions that have assets, institutions that have investors, and create this digital chain from asset through to ultimate beneficial owner. So I think there's a bit of idealism behind some of these conversations. Institutions are actually very business focused and quite pragmatic, and ultimately looking to solve business problems. And the business problem is, how do you efficiently create chains between asset and investors and enable that to scale at a global level, so your high net worth or accredited investor can discover assets all over the world, click to invest, click to trade, click to borrow against them.
And that's actually, why don't we just push on that point a bit? So how do you feel that TradFi should work, in collaboration with, let's say, with other fintechs out there in order to, collaborate in this space, build up, establish these use cases? Because you see, sometimes there's this dichotomy, right? TradFi is working sometimes in their own little bubble, fintechs are working in their others. How do you bridge that gap, or do you see that's being bridged, and in what ways?
Yeah, I mean, the short punchline is they need each other. What I didn't do in my introduction, I didn't say I was 25 years public capital markets on the institutional side, a bit like Morgan at various large institutions. It's worth reflecting that the world of crypto that inspired a lot of this tech was quite retail, right? It started retail, quite niche actually, relatively small, that world. It's only got a market cap of about $1 trillion. But when we're talking about tokenization of real world assets, we're talking about the largest market on the planet. Where are the assets and where are the investors? Well, the institutions have the assets and they advise the assets. The institutions have the large pools of accredited and high net worth investors through their wealth managers, private banks, etc. And you're not going to have a situation where a fintech can create a venue and scale and take over that world. It's not going to happen. At the same time, the institutions that have the assets and the investors also need that innovation and the change of approach that comes from outside of what ostensibly historically has been the public capital markets to say, well, how do we digitize the private markets? And so you have fintechs that are bringing on board digital exchanges, you've got tokenizers, all moving very fast, a lot of energy, many of the companies that are in this room. But the solution is for them to work with those large institutions to unlock this chain between asset and investor. That's what we're very much focused on. You'll hear actually for a bit from me tomorrow morning about how you bring the industry together, large institutions, fintechs, tokenizers, exchanges, to make all of this happen.
Yeah, just obviously as a large incumbent TradFi on the panel, yeah, entirely agreed. I think we think about it in terms like build, buy, partner, invest. We think about what outcomes we're trying to achieve, and then we map against that. And I think the key thing for us is like open architecture approach with the right partners to deliver value for clients. And that again means like, what are we good at? What are our partners good at? For example, like we built our digital assets platform on digital assets. We're working with a bunch of companies in this room on different projects. And the key thing there is like time to market, skills, expertise, and just being really honest on like, our relative strengths, whether it's like data, people, balance sheet, product and technology expertise, and then fusing them together.
On that front, yeah, just to add to Ali's comments and Anthony's, so if we think we're creating this new digital factory of finance, right? We're automating via blockchain how financial services works. And one instance where fintech can help is on the origination of assets, right? So figures originating these HELOCs and mortgages and distributing it to banks that have large balance sheets. And if you put that asset on chain, you tie the credit file with a bow and you programatize. This was a 250 million asset-backed securitization, and it'll happen every 6 weeks. Then you allow more credit coming into the economy, as an example, just to throw out sort of. And the other area I think where banks should really be leaning in, and it's fraught with sort of regulatory challenges, but banks should be minting tokenized deposits, right? Banks should be part of the money equation, right? There's 70% of the cash is sitting in banks, and that's trusted vaults for customers. And if banks can be allowed to tokenize those deposits to pay for financial assets or embed with a financial contract, right? All financial assets give off of cash flows or request cash flows. So you really can get into the programmatization of money and automation of money, and that's really important. So that's another area I think that fintechs and banks can collaborate.
And that's a fantastic area, I guess, of value of what we see right now. I guess just moving on to the next step, it sounds like we're seeing that there's a lot of this already in place. It's growing. There's collaboration. It's growing collaboration. But what do you think some of the headwinds are, then the challenges? I mean, I don't want to necessarily lead the witnesses here, but you guys have mentioned the word regulatory a couple times throughout your responses. I'm sure that's going to come up, and I'd love to hear some of your comments. But if there's anything else, and why don't we start with you, Yuval, and Anthony? I think you have some thoughts as well.
Yeah, I think Ollie is best to answer that question. But at least from my perspective, a lot of times when I talk to clients, they mix when they talk to regulators between using blockchain and effectively digitizing securities, which is something that people have been doing a long time ago. People talk about tokenization will lead to fractionalization. Well, Robinhood fractionalized equities before anybody was talking about tokenization. So you don't need tokenization to digitize products and make them more efficient, but there's a really good use case for this technology. On the other hand, there's the use case of crypto assets, which are bearer instruments, which do bear risk. You could actually lose the private keys and the assets are gone. And when I hear customers describe to regulators what they're going to do, a lot of times they mix those two topics, which freaks regulators, in my opinion, rightfully so, because they hear that I'm going to issue $100 million of an asset, and if someone loses their private keys, the asset is gone. And that doesn't make sense in real world asset. The previous panel talked about real estate. You lose your private key, you don't lose a portion of the building, right? So I think that that's one of the headwinds that people deal with these days, and I think that continuing to understand the subtle differences between those different types of assets and use that to educate regulators can help a lot. I also think, kind of similar to the previous conversation, how fintechs can help is understand the business of your clients. Because a lot of times I see fintechs that are very smart from a tech perspective but have no markets experience talk about, we can settle everything in real time. And then the banks say to them, well, that's not capital efficient, right? Netting and settlement makes things much more efficient. So actually having a good understanding of why is the system working the way it does, and there's a lot of areas which is historical baggage that could become more efficient, but there are a lot of reasons why the system works the way it does for good reasons. And I think that it creates headwinds for the industry for no reason, mainly because your customers think you don't know what you're talking about. And it creates, bad reputation sometimes to the industry.
Anthony?
Yeah, actually, didn't think I was going to say that, but just briefly on one of the last points, you talk about things like real-time settlement, and actually people in the markets will often say, well, we don't need real-time settlement, we net, etc. But often there's an element of hiding behind the technology because the technology has been the constraining factor on delayed settlement. Actually, technology shouldn't be the constraining factor. You should be able to settle instantly if you want, or in 2 days if you want, net trades if you want, or not. So it was just point of detail. But in terms of headwinds, I think it's important to understand what isn't headwinds in this environment. The technology isn't a headwind. The technology's here. We've got great companies here tokenizing real-world assets, distributing them to investors. We work hard with the industry to develop an open source peer-to-peer protocol to open up those distribution rails. It's not technology. Personally, I think it isn't, or it shouldn't be, regulation. So as Yuval said, we're talking about tokenizing real-world assets. You're invariably talking about regulated securities. And we have some very good securities regulation out there around the world. And there is a lot we can do now under the umbrella of existing regulation. You can distribute private market assets to accredited and high net worth investors all over the world using existing regulation and regulatory exemptions. There is an education issue, and there is an issue that there's so much noise coming out of the world of crypto that sometimes the regulators are at risk of throwing the baby out of the bathwater. We say, look, if I got a regulated security, I don't need any other regulation. Securities regulation works fine for me. So that's the regulation point. But I think where there is the headwind or the challenge at the moment that we're working together to overcome is actually there's both supply out there in terms of high quality assets, and there's demand out there from the wealthy of the world. And eventually it will go retail, but for now we're talking about at least getting high quality assets down from the hands of pension funds into the ultra high net worth and accredited investors. But you've got to bootstrap that, right? As soon as you've got high quality assets, investors want those high quality assets. You've got pools of investors, they want the assets, but you have to bring the two together. That's what a lot of firms and institutions here are in the process of doing this year, is getting up and running with the first pools of very high quality assets that those high net worth want access to, being able to distribute those to some of the largest wealth managers, multifamily offices, etc. Once you do that, those assets that are there being distributed attract more investors, the investors there attract more assets, and then we see that tipping point, and then you add to that network, and then you start to see all of this going electronic.
Yeah, it'd be interesting to hear Morgan, Ollie, what your thoughts are from a financial institutional perspective.
Yeah, sure. Interesting. Yeah, I was just kind of thinking about your comments. I'd say from my side, probably there's like categorize it into like 3 topics around headwinds. I think one is market structure. Like, it's actually really difficult bringing together the two sides, as you said, like supply and demand and the distribution, whether it's like private markets or other product areas we're looking at. So I think one is just like, it's consortia building, it's working with your peers, your competitors, all the stakeholders in that value chain that you're looking to tokenize. If you don't get that right, then there's kind of no point to what you're doing. And I just think that's like brutally, extremely painful. And that's why it's been a slow journey thus far. But I think there's like, this year, as Morgan rightly pointed out, or maybe the last 12 to 18 months, we're at this inflection point where I do think you're going to see some real use cases and businesses in the enterprise blockchain space. So that's one, is market structure, like you're ripping out finance, you're creating a new digital factory, which I love that phrase. The second piece is I was using the word technology, but I agree there's like a lot of technology solutions out there, but it kind of relates to market structure, and that's like, it's a new way of doing software development. And that's actually, at least within companies like us, like working with decentralized systems when you have to think about like resiliency, BCP, and actually managing a network across an industry, not just our own software on-prem or in our own cloud environments. It is a different way of building product, which is another headwind. Like, there's a re-education process you have to do as a software engineer. And then the third piece, I was going to say regulatory, and I think my take on that was, that education piece. Like, even though it's still a security in your example, if it's stored in a digital asset which has public key cryptography, like there's a lot of education and novel law that needs to go into some of these assets just to make sure that, okay, it lives on a blockchain or a DLT-based network. Can it fit into the existing laws and regulation? And that's like non-trivial. And that's probably my 3 takes. Like, yeah.
Morgan?
Totally agree with that. Maybe what I would add, I think we're quite convinced that if you fast forward a decade, a lot, and I know there's been varying numbers in the room earlier today, but a lot of financial services will be natively issued on chain, operated on chain, and will have digital fiat issued by regulated players on chain. To get there, you have to build the bridge slat by slat over Death Valley, right? And it means asset class by asset class. And starting in your use cases are critical to pick, and we're starting in high friction use cases. That's the private asset space, which, as everybody's pointed out, is bigger than public securities. And then you need to get at the coalition of the willing and able, right? If you're convincing skeptics, you're wasting your time, and you just have to start building all these valuable benefits that each of us have seen across different asset classes. And I think digital money will be a catalyst. It will be important. That will take time. That's a barrier. I agree, the reg framework, it's not just about the tech, it's actually about the legal protection. If you buy the asset on chain, you have to make sure, and mortgages was a great place to start. Mortgages have an e-note that existed before blockchain. So you issue the e-note on chain, and it's codified. If everything hits the fan, if you own that e-note, you have the lawful title, and then you can perfect that collateral on chain as well by filing the UCC. We have something for that called DART. So I think, there's many obstacles, but you walk before you run in blockchain, and it's step by step.
Excellent. So should we see if we have any questions in the audience?
We've solved everything.
Could you kindly elaborate what DART is?
Yeah, DART is Digital Asset Registry Technologies. So if a figure issues a mortgage, an e-note on chain natively, for Goldman to want to buy that e-note, it has to be convinced it actually owns the underlying collateral, right? So DART basically electronically files the transfer of the lien so that, when Goldman buys it, they know that they're also holding, not only do they hold the loan, but if the borrower doesn't repay, they actually own the collateral, the house. And we need that across a lot of other asset classes, this perfection of assets also, because it's how you design the issuance to make that life cycle go well for buyers, right? A lot of financial services transference of risk.
So in that vein, do you see blockchain
Well, I think our point of view, and I'm sure the panelists have other ideas here, but we focus on natively issuing assets versus tokenizing something that an offline TA has to say. They have to wake up the next morning and say, well, you bought the thing on blockchain, but now you really own the thing, right? So we're trying, I think, this is about how do you automate the full life cycle of the issuance and then the fund admin, or in the lending case, the filing of the UCC. So asset perfection is quite important. I don't know, and you'll need interoperability across chains, so it's a very difficult question to answer very quickly. So we can chat offline. I don't know if the other panelists have a view.
It's both a question of what is the legal framework, because there are these registries that are mandated legally. So in that case, yes, blockchain can help facilitate to be a clearinghouse or a settlement house, but at the end of the day, the legal title will be deemed by these registries, CSDs, whatever you want to call it, depending on the asset class. Then there are areas, for example, we're doing a project in leverage loans, which is a not regulated market, right? It's actually as big as the bond market, sometimes larger, sometimes smaller. And there's no legal framework, so it's really the registry of the agent bank that is the legal framework for the registry of a loan. And there, as Morgan said, there's an opportunity to make blockchain the registry for these assets from day one, and it can also become a settlement layer for these assets. So I think it's on a case-by-case, depending on the asset.
I'll just throw in one other in the middle, though, because I think in the Celsius transaction, as an example, the blockchain will be the source of the record. There will be no clearinghouse old school. There will be no DTCC in this instance of a public security. It'll be issued natively on chain, traded on chain, live the registry of ownership living on chain. So I think we'll see some disruptive models happen soon.
Great. Well, thank you to all our panelists. And I just want to end really quickly with the lightning round question. I just want to be very clear. This is not investment advice, but where do you guys feel Bitcoin will end at the end of this year?
I don't own a lot of Bitcoin, but I would say it'd be higher.
I have no idea. It's a social construction of value with no intrinsic value, so I don't know. I'm more of an ETH person, but...
Sounds like there's room for another panel here.
If interest rate keeps on going up, which I think they will, then Bitcoin will be lower.
Anthony?
I think my absolutely honest answer is I don't care.
Great. Thank you very much to everyone on the panel. Thank you.